The S&P 500 has rallied quite a bit over the last few weeks, so today I want to readdress the question of, is the S&P 500 a good value right now, or is the market overpriced? In this video, we're going to talk about three things. One, we're going to look at the relationship between interest rates and dividend yields going back to 1960. Then we're going to look at what that relationship can tell us about what the S&P 500 should be trading at today. And then at the end of the video, we're going to look at dividend estimates over the next 2 years. And we're going to ask where the S&P 500 could go at the year-end 2022 and year-end 2023 if those dividend estimates come true.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
This video is sponsored by all of my Patreons and YouTube Premium supporters. Thank you all for helping to make this channel possible. So first, and very importantly, we need to look at what the relationship is between interest rates and dividend yields. And we need to look at interest rates because interest rates have a major impact on the valuation of the market at any given point in time. For example, this is from an article that I wrote back in December of 2021. And in this particular valuation model, I was looking at the historical relationship between earnings and prices, stock prices, and interest rates. And at the time, the 10-year US Treasury yield was at 1.416%. The model estimates that the trailing PE at the time would have appropriately been 27.2, making the fair value of the S&P about 4,400. At the time, the S&P was trading at 4,550, so this model suggested that it was slightly overvalued at this interest rate, but not significantly so. However, if you take a look at this chart, if the US 10-year were to go to 3.4%, which it did earlier this year, then the model suggests the PE would drop significantly to 22.6. And that's pretty much exactly what happens. You can see the estimate at 3.4% on the 10-year was 36.53, and the S&P just hit a low, currently intermediate low of 36.66. And I believe almost this entire bear market has been caused by this change in the 10-year US Treasury. There's a lot of talk about recession, etc. But based on this model, I really don't think the market has discounted much of a recession impact. I think it's almost been entirely a multiple-driven correction. And that multiple correction has largely occurred because of an increase in the 10-year. Here's a chart showing us the historical relationship between the 10-year US Treasury, which is here in this red line, and the dividend yield of the S&P 500 index. There's certainly not a perfect relationship, but in general, as the 10-year US Treasury, this red line, increases, so does the dividend yield of the S&P 500. And remember, this green line is basically the inverse of what the stock price chart would actually look like. So when the dividend yield is going up, that means that the price in relation to the dividend is going down. So just at a casual glance, it's pretty clear that if interest rates go up, that means that the dividend yield should in general go up with them. And if interest rates go down, that means the dividend yield should in general go down. But instead of using our eyeballs to try to guess what the correct dividend yield would be given the current 10-year yield, we can actually plug this into a regression software. I like to use Gretel, and it will basically tell us, using this historical data, what's the correct yield, or at least correct yield given the historical context for that particular yield level. What does that historical relationship tell us about where the S&P 500 should be at right now? The current dividend for the S&P 500 is $61.97. So if we plug this into the equation and punch in the 2.64% 10-year yield, that suggests that the fair value of the S&P 500 right this very second should be $39.70 compared with the current S&P 500 price at $41.14. So right this very second, the S&P 500 is just modestly overpriced. but definitely within the statistical range of fair value. But as a stock investor, you're not interested in the current situation. You're more interested in what's going to happen in the future. So what would happen if we took the dividend estimates for year-end 2022 and 2023 to try to answer the question of where the S&P 500 could go in the future? So if we just keep the 10-year US Treasury yield the same as what it is right now, and this is key, if yields remain exactly where they are now, and the 2022 dividend estimate of 64.81 were to come true, and the 2023 dividend estimate of 69.74 were to come true, what would the value of the S&P 500 likely be? And then what would the total return be that you would likely get based on today's prices? The model's year-end S&P 500 estimate on price is 41.85, and 2023 year-end, the estimate would be 45.60. The total return estimate at today's prices for year-end is a pretty meager 2.4%, or annualized comes to about 5%. And then the 2023 total return estimate would be 13.2% based on today's prices. The big risk to this forecast would be, one, if interest rates would go up again significantly, then we're likely to see stock prices fall in relation to the dividend, and we could have more downside in that scenario. Conversely, if interest rates continue to fall, I would expect stock prices to continue to rise. The other big issues is if you get a dividend slowing or the growth isn't what is currently expected by Wall Street, that's going to have a negative impact on the forecast. And then obviously if you have an 0809 scenario and dividends get cut, by 20, 25%, that's going to have a significant negative impact on the price estimate from this particular model. But if you continue to get dividend increases and interest rates can stay below, say, 3%, I think there's a very good likelihood that over the next couple of years, you should make at least some money in the stock market. Despite all the negative headlines right now, I think investors would do well to just stick with their predetermined plan. If you're investing for the next 20 or 30 years, probably not going to make much of a difference whether you bought right here or 10% lower or even 20% lower. And to show why that is, last year I made a video comparing how well someone did buying at the absolute low in the market each and every year, compared with someone that bought at the absolute high each and every year. The results of that study were actually quite surprising. If you're interested, you can check out this link right here.